Scott, thanks very much. The Federal Reserve reporting that household net worth rose to a record $137 trillion, up by $5 trillion in the first quarter. There were big gains in real estate, big gains in equity holdings by households. Corporate debt also is on the rise again. Maybe that's a good sign. Companies are borrowing. A record increase in real estate wealth. Equity holdings by households up by $3.2 trillion. Real estate holdings up, I believe this is a record. I can't go back any further, up by $1 trillion. Debt overall up 5.8%. There were gains in household debt, business debt, and federal government debt. But there's a big number here. Real estate equity, the percentage of equity by households is up to 67%. That's the highest level since 1990. Bottom line, Scott, as of the end of the first quarter, households had an awful lot of money.
They sure did. The wealth effect times a lot, Steve, throughout a whole swath of the economy. We appreciate it. Steve Leisman, thank you very much, our senior economics reporter. Let's bring in the gang now. Steve Weiss, this is a bullish sign. And if you take what happened today, if I told you the CPI was going to run hot and everybody was waiting for that number and rates would tick lower, we're at 147 on the 10-year as we have this conversation here, and stocks higher. The S&P hits a new record. I don't know. Maybe you would have said, I don't think that's going to be the case. But it is, and I wonder what that means to you.
Yeah, I definitely would have said that's not the case. And I was worried about a hot number, hotter than what we saw. I think the number that came out, even though it was above expectations, was already absorbed into the market. Nobody's surprised it's running hot. What it means to me is that with rates coming down, is that we have a market that's going to continue to rise into the end of the year. I don't think you'll see an explosive move up in the indices, but I think that if you're very picky in terms of sectors, in terms of individual stocks with idiosyncratic stories and risk, that you can do very well and far outperform the market. So we've said it so many times, it's a stock picker's market. It'll continue to go, it's panacea. And the best news about all this is that the Fed has tremendous credibility. And I buy into the thesis that inflation is transitory, and the market's buying into it. So it's tough to see any real bumps coming along here, because anything that comes out will be transitory. Now, if it goes on for 6 months, that's a different story. But I don't think that's what's going to happen, because supply chains are coming back to life. And we had VW coming out today and saying third quarter we'll get our semis that we need. So I think it's Goldilocks right here. So I'm nearly fully invested.
I think you nailed it. I mean, I really do. Brenda, that's what this is all about. It's a fact that the market trusts the Fed, at least for now, and that's good enough because, okay, so inflation's going up. Market thinks it's going to be transitory. Should we buy stocks now?
I think there's certainly an argument for owning stocks here. I mean, the stock market, if you look back over the last 3 months, the S&P really hasn't done much of anything, and it's been against a backdrop of improving fundamentals, incredible earnings growth. So we've had a lot of positive things happening, and the market hasn't really reacted. We've been kind of in this wait and see moment, I think, with regard to inflation, because that's all anybody has wanted to talk about. But here we are, and we're getting the real numbers, and we can see, looking through, that some of the categories that have experienced the most increase, it's not sustainable over a longer period. So perhaps some of it is transitory. I think only time's going to tell, though, as we move throughout the year, whether some of these price increases will stick or not. But I agree that this is not a bad moment to be invested in the stock market. Certainly, if we look at alternatives, within the bonds being the alternative, it's definitely a better place to be. I mean, even though rates have ticked lower during this time frame, we just think against the backdrop of improving economic growth and inflation getting at least back to normalized levels, that rates are not likely to stay where they're at today.
So, Josh Brown, Steve Weiss used the word Goldilocks. Is this how a summer surge in stocks begins? Because of how the market reacted to what the inflation read was today, and it didn't seem to be all, in a fuss about it?
Well, we talk all the time about whether or not the Fed believes inflation is transitory or some aspects of inflation is transitory. The market believes that inflation is transitory. And the market may end up being wrong, but that is the only read-through that I can give you based on price action in reaction to the news that we've been getting really since April. One thing I would point out, though.
forgive me for interrupting you. Forgive me for interrupting you real quick. You're the one who, and I'll give it back to you, please. Forgive me for doing this, but you're the one who always says price is the thing, right? Believe in price.
Yeah.
You can say whatever you want, but price tells the story.
Well, yeah, because price is people voting with money, right? So the world is filled with people who write newsletters for a living, and there's no money behind it. So what is the money saying? And again, the money can change its mind. So the market is dynamic, but at this current moment, the market is saying, yes, higher prices will stick, but we're not going to see 5% year over year price growth for as far as the eye can see it. It probably moderates this fall. Why will it moderate? Well, a combination of manufacturing coming back online. They're not going to be shipping trucks without chips for very much longer. Some aspects of construction and building. We're starting to see buyers for new homes get sticker shock because of price increases over the last 6 months. So that might cool that market off. But then there are elements of inflation that are here to stay. And by the way, as we've talked about, forget the comps year over year, which is what these headline numbers are. Let's just look at comps versus 2019. We're still above what the Fed thought its target for inflation should be for a long time. If you go May 2019 versus now, it's about 2.5% growth per year. So it's 5% over 2 years. That is inflation above the Fed's target. So even if we pull out the base effect stuff from 2020, we're still running a little bit hot here. And that's undeniable. So it's not that we shouldn't worry about higher prices. It's that clearly the stock market is and has been processing those higher prices in the economy. And on balance, it's saying this is not ruinous.